and what you may have picked a stock up, what price that may have been, okay, what the conditions are, okay, your expectations. This is where it gets a little fuzzy because we don't know what's going to really happen, but we can certainly act on our expectations. Whenever we make an action, it has to be in light of our goals. If your goal happens to be long-term growth, why you might have other types of actions that go with that. If your goal in this particular deal is to make a short-term profit in 6 weeks or less, well, this might be the action that you take. Okay. So there are several ways to play if you own the stock. Okay, you may just play it as a straight stock deal, you know, buy in and get out. You may do a covered call, which I call the gateway drug. It's how most folks get exposed to the world of options trading, and it's the first thing that usually you get approved to do in your trading accounts. Okay, but then we're going to also show the money net, which is a safe way to pull in a little bit of credit, but also to perhaps pull in more than a covered call. Okay. All right. So let's say the stock does obey our expectation. We thought it was going to go. We got it at 92, and we thought it was going to go to 94. Okay. Well, if it did go along with our expectations, by the way, this is an actual graph of Chipotle Mexican Grill, CMG, that I picked up a couple of years ago. Okay. If the stock is at 92 and then it goes to 94 and you sell, Mike, do you still have the stock?
No, we're out of the stock, we're out of the holding, but we have our $2 profit.
Okay, so we don't have any opportunity to hold on to the stock and see greater gains. All right, but we have made a profit, and that's all right. Okay, so we've made $2 here. Oh, now the covered call play. This is kind of interesting. Okay, at the time, Chipotle Mexican Grill was trading at 92. Okay, and the $95 calls were trading at $3.30 bid by a $3.60 ask. Now, Mike, with a 30-cent spread like that, would you go along with me and say that with a limit order you might be able to get $3.40 premium?
Yeah, most likely you'd be able to get filled at that price. Depending on the activity of the day, you might even be able to get it filled at $3.50. But $3.40, I'd say, is a safe assessment.
Okay. Now this is a $95 call, and so if the stock goes to 94, what's going to happen to that call?
Well, it's going to expire worthless. It won't have any value, and you'll keep the $3.40. So you'd have lowered your cost basis on the entire position down to $88.60, and you still have the stock. Cost basis of $88.60, and it's trading at 94. So you have about a $5.40 gain in the position.
Now, after this expires, I can certainly hold on to the stock, and it can continue to move up. Yes.
Yes, and you could sell another call, of course, right? You could sell a 95 call for I don't know what month this is. I apologize, but for the next month out, for example.
Right, and it's not. I didn't actually give the months because I wanted this to be kind of a timeless example.
There you go.
But yeah, but the fact is, yeah, this is why so many folks love covered calls, is because, well, geez, you know, after you collect premium, you could do it again, conceivably. And that's all right. That's good. There is a dark side to covered calls, which we're going to address here pretty soon. But that's certainly one reason that that's popular. Mike, I got a question. If I was to sell 2 of those $3.40 premium getting $95 calls, if I was to sell 2 of them, I get double the premium, right? Yeah,
but now you kind of have a problem, don't you?
Well, I don't understand. I mean, if I have 100 shares of stock and I sell 2 $95 calls, what's the problem with that?
Well, one of those calls is going to be naked. It technically has infinite risk as the stock moves up. Sure, if the stock ends at 94, that might work out for you. But if it went up to 100 or 110, you have an obligation to deliver shares of stock at 95 that you don't own. One of those calls is covered. The other one is not.
Right. Now, you might argue, well, geez, you know, if you short a call and your stock goes up, you could just keep rolling the call. Well, let me remind you that Chipotle Mexican Grill got up to about $200 a share.
Right.
so that probably would not have been the best way to go. So you know what I'm going to do? I am going to sell 2. I'm going to sell 2 $95 calls, but with the proceeds, I'm going to buy a $90 call. This is something called a ratio call spread, where you buy one and sell two. And here's how it goes. We sell two 95s, okay, at 340 premiums, so we get $6.80 total premium. And then we turn around and use $5.80 of that premium to buy a $90 call. Now, Mike, I get a net credit of $1, which is less than I would for a covered call.
Yeah, you would have gotten 340 on the covered call. That's right.
Right. But remember, my expectation is that the stock is going to go to 94. And if it does, in fact, go to 94, here's what happens, Mike. The $95 calls expire worthless, so I have no obligations, right?
That's right.
All right. But the $90 call is in the money by $4. So I collected $1 on the front end. And those 95s expire worthless, and now I get to collect another $4 by closing the long call.
Right.
Pretty cool? Okay. And what I've done is I call this the money net. We've caught some premium in the money net. Rather than picking up just that $1, we got the $1 on the front end just for putting it together. The stock moved up by $2, but as it moved up, the stock moves up, yes, and also this long call moves up, and so we get the benefit of both. I'm now holding a stock that I got at 92 that's worth 94, and I've collected $5 in premium. Pretty cool. Okay. Now, Mike, if I had just played the stock, I would have been out of the stock and couldn't hold it for further gains. Okay, so I'd make $2, and that's fine, but I've got no stock left. The covered call, all right, if it obeys my expectation, if the covered call goes up to 94, yeah, I collect the $3.40 premium, and I still have the stock. All right, so that's a really happy thing. But with the money net, I have collected $1 on the front end, $4 more, a total of $5 premium, which is bigger, I think, than 340. Yes.
Math says that is correct, sir. Yes.
Right, and it's in the same context. It's in the context of owning the stock. Now, the thing is, I'm going to probably answer everybody's question. What if that stock goes above 95, Kurt? Then what? Well, that's what this webinar is going to answer. We're going to put that at the end because I've got to do a little bit of background and show how this is actually done with zero risk. It's actually done without any risk to your account. And the reason that it's done without risk, the ratio call spread, is because it's done in the context of a married put, where you already own the stock and you're already protected against a downturn just in case something really bad happens. Pretty cool?
Pretty cool.
Pretty cool. All right.
All right.
Good.
Now, real quick, Larry
We've
asked.
got questions coming in already. Go
Well,
ahead.
someone wanted to know, is that you holding the fish? And no, for lack of a better term, that was just a stock photo of someone holding a very big fish. But the more important question from Larry is, isn't there a risk in having one uncovered call? Well, we didn't, Larry. We owned 100 shares of stock, sold 295 calls, and bought 190 calls. So essentially what we have is a covered call with a bull call debit spread that was received at a credit. So there wasn't an uncovered call on any side of that transaction. We had 100 shares. We sold 2 calls at 95 strike, and then we bought a call at the 90 strike. So that created a bull call debit spread, 190 call, 1 short 95 call, and the covered call, 100 shares of Chipotle Mexican Grill, and the other short 95 call.
Okay. Now, Mike, right away I'm going to ask this question of our audience, okay, because I'm not sure that everybody got your explanation. And I know that some folks probably was able to follow that, okay, but maybe some folks have not. And while this poll is filling in, I'm going to change presentations. We're going to get into the covered call. I'm sorry, the married put presentation. Go ahead.
I was just going to say the meat and potatoes.
And the meat and potatoes of today. Okay, and we've got a small percentage of folks saying options mean alike you, so I'm going to say that they probably didn't get what you just said.
I see. Okay, fair enough.
But that's a small percentage. A lot of folks are getting it because I've got 57% of our audience doing spread trades already. Okay, so they know what a bull call debit spread is. Here's what we're going to do for Larry. Larry, when you sell 2 calls against 100 shares of stock, only one of those calls is covered. And it's covered by what? It's covered by the stock that you own. what we did was pick up a long call. And now that other short call is covered too. It's not covered by stock. It's covered by a long call that you own. But this is interesting. You own it at a credit. You've been paid to own this call. Kind of cool. All right, let me go ahead and close this and share the results. And I got 60% spread traders and 64% doing long calls and puts. So a pretty sophisticated audience. But half are doing covered calls. All right. So we're going to do a little education on that. 2% are comfortable enough to do naked calls, and that's a minority. But you know, I'm cleared, Mike, to do covered calls, but I don't. And the reason I don't is because I'm just not that confident in my ability to predict the market. 2% say options mean to like you. There's only 2 reasons I would think that you don't like options, and one would be that you just don't understand all the technical jargon and so forth. There's a cure for that, and the cure is education, and you can get a lot of that education from free sources, including these webinars. All right. The other reason why you would not like options is because you've learned enough to get into a trade and then found out about the inherent risk of your position if you didn't get enough education. Okay, so again, the cure is we're going to teach you about risk. Okay, not just about options, how to do an option play. Hey, guys that do that are a dime a dozen. Here's what we do. We teach you about risk and how to use options to limit risk. Cool. All right, Mike, let's get in. Let's roll. Quick introduction. I lost everything. That's what qualifies me to be your stock market training guru. No, what really happened here, Mike, is in the early part of 2000 and the late 1990s. I had been trading covered calls and certain spread trades and so forth, and I got cleaned out. And the reason I got cleaned out, I was able to understand the play, but I wasn't able to understand what the risk was, what risk meant. And I was just following directions and got hurt. But made up my mind I was going to get back in there. I teach mixed martial arts. That's my occupation, is that I teach folks to get in the cage and beat up at each other. And I'm not the kind of guy that backs down from a fight, and especially when I'm down. That's when I make up my mind I'm going to learn something and come back and get you. And so that's kind of the background of how I got started. Mike, now you've got some background with the Power Options Company. Why don't you just give a real brief introduction, and we'll ask everybody to participate in the polls and the prompts, okay?
Yeah, I've been with Power Options for 8 years. I'm the Director of Education here at Power Options. Power Options is a patented suite of search and analysis tools for self-directed options investors. We support over 23 different strategies, protective strategies, standard covered strategies, credit spreads, debit spreads, calendars, straddle strangles, butterflies, condors, and so forth. So I've had similar education to many of our attendees, what they might have experienced. I learned covered calls first, and then I went into naked puts, and I had the sorting machine experience that we'll talk about a little bit later in the presentation. I moved into standard collars, which I still trade, and some calendar spreads, and I had a lot of success with calendar spreads for about an 18 to 20 month period. And then I had a bad time frame, and it essentially gave back a lot of what I'd made in those profits on the calendar spreads, a lot of deterioration in time value and a lot of decays on the stock prices. I came across Kurt's path 3 years ago. Kurt had already written the blueprint, had the radioactive trading site going, but he was a customer of Power Options. He wanted to know how to use the historical tools. And as we started to look at his presentation, I made my comments that I'm not sure if I understand, Kurt, how you're going to make money with this setup. And Kurt invited me to his free webinars that he was also doing at the time. And, excuse me, that led me to, I attended the webinar and I saw what he was doing. I invited Ernie Zarena, the president and founder of Power Options, who'd been trading for about 20, 25 years. And he was so impressed with Kurt's technique that we decided to partner up with Kurt and radioactive trading in the blueprint. And now both Ernie and myself trade radioactively in our accounts. I still do standard collars and a credit spread here or there. And real quick, Amon asked, is PowerOpt a brokerage as well? I can't seem to find the commissions. We are not a brokerage. We are merely a suite of tools for self-directed options investors, Amon. We don't have a brokerage platform. So we don't we don't handle the trades ourselves.
Right. Mike, it's been a rewarding experience, and we're going to show folks exactly the solution to the question that you asked. You said, Kurt, I don't see how you're going to make any money with this. It didn't look like it works.
Mm-hmm.
But then after you saw the webinar, you did know.
Mm-hmm.
And since then, it's been a pretty fun ride, hasn't it?
That's right, absolutely. I've had some great success, and even had success on positions that were complete failures, and I was long stock the entire time.
That's right. We'll probably get into that later, talking about
Mm-hmm.
your position where you lost the stock went down 75% and you actually made money even though you were long the stock. But Mike, let's talk about this. I'm going to show a simple truth that successful traders have said over and over, but they've often said it without the practical directions on how to achieve it. For example, here's a saying like that: buy low, sell high. That sounds great. I'll just do that, right? But where's the practical instruction? How do you do that? All right. Well, here's another saying. It goes like this: cut your losers short. Mike, you know the rest of the sentence. How's it go?
We want to let our winners run, don't we, Kurt?
That's right. Let your winners run. Okay, and that does sound familiar. All right, but most of us don't trade that way because we don't have the practical instruction of how to do it. But what if you could guarantee that you would always do this? What if that was the default? I mean, that you forced yourself into a position to where you would cut your losers short if it went against you, okay? But you could let your winners run. That'd be valuable, wouldn't it?
That's right. Very valuable.
Here's the promise, all right? I'm going to show you a practical, workable, reliable way to put this vital principle to work, okay? And it will instantly improve your trading results, all right? I guarantee it. This simple formula is being used, actually, it's more than 30 countries now. And it's safer and more effective than methods that are being taught in these weekend seminars. These weekend seminars, Mike, they're $3,000 or $3,500, and you come away retaining maybe 10% of the material, right? And I'll tell you what, I got in trouble. I got in a lot of trouble. Sound like you're getting ready to say something. What was it, Mike?
Oh, nothing. No. It's just, it's just the price difference. We've had so many people like you. You suffered through this too. I mean, you paid $2,500, $2,000 to learn how to trade one way, and you weren't informed about the downside. And the market was really your education. And a lot of customers I've talked to over the past 8 years said the same thing. I didn't learn much in that 2000 weekend seminar. I learned enough to get into trouble. The market taught me the rest.
That's right. $34.95 is what the cost was on my seminar, the weekend seminar that I attended, not what I charged for. And the market did, in fact, give me a bigger education and more expensive one. Okay, so I'm gonna give away today this top secret principle. It's so important. If you get it, it will transform your trading results, and I'm giving it away for free. Okay. In return, I'm going to ask something from everyone, and that is at the end of the webinar, I'll be making a special offer. Okay, I don't want you to invest in my program unless I fulfill my promise to you, how to instantly improve your trading results. But if I do, I think you should feel it's only honest to take advantage of my offer. Okay, if it has a fairly price and risk-free guarantee. Okay, so is that fair enough? I'll just ask maybe a couple of folks out there to text in. If you think that's fair enough, tell me. If you don't think it's fair, well, keep watching anyway. I think you're going to be pretty impressed. Okay, we've got a few responses already, and I appreciate that there, folks. Okay, all right, so we're on the same footing. Let's review that saying. The saying goes like this: cut your losers short and let your winners run. I wonder if the strategy of selling covered calls or selling naked puts goes along with that idea. Does it sound like it does, Wayne?
No, it's actually the reverse, isn't it, Kurt?
Yeah. When you sell a covered call, what you're doing is you're taking a bit of premium on the front end, but you're also agreeing to let your stock go at a certain price. If that stock goes in the direction that, well, that you hope it does, I mean, you hope it doesn't go down, right?
Right. That's right.
If you buy a stock like I did, I bought a pharmaceutical company, at 20, around $20 a share, $17 a share, and she went to $9. You don't want to do that with a covered call. It's not happy. All right, but on the other hand, if the stock does what you think it will, or you hope that it will, you don't get to share in too much of the upside. Okay, so what about this? What about vertical spreads, which at least 60% of our audience is doing, in condors? Uh, Mike, if your stock goes, far up and away, if you've got a bull call spread in place, for example, your risk is limited, right? So in a sense, you cut your losers short, but can you let your winners run with that?
No, you still have a capped gain. I mean, sure, you can put more money in and try to make an adjustment, but with what? As the stock moves up, your put can't gain any value if you're in a bull put credit spread, as you mentioned. I mean, your put can't gain any value, and the short put already has received the maximum you can make off of it. So without putting more money into the position or adjusting it, no, you have a capped gain on the position, but you do have a capped loss as well.
Yeah. So the cutting losers short part does work, but the letting winners run does not. What if you are in a condor and your stock just takes off for the moon? That's a happy thing, right?
Mm-hmm. That's a very happy thing.
No. With a condor, you're in deep trouble. Okay, if the stock goes, if it goes way, way high or way, way low, either one, it's the worst possible thing that can happen. Okay, you want, for a condor, you want your stock to trade sideways.
Complete neutrality.
Yeah, so there's really no way to let winners run.
Mm-hmm.
That. Okay, all right. So I'm going to take issue with this propaganda that's out there, Mike, and I've done a couple of blog posts here recently that are getting a little bit of buzz, and I've got a video out there called "The Trouble with Covered Calls," and it's had something like 13,000 views. It's pretty ridiculous, but I take issue with the propaganda in the market. It is a bullish strategy when you purchase stock. Okay, and this is a graphic that I pulled off of Options Express, just one of the free education sections in Options Express. The expectation is bullish, right? You buy stock and you think it's going to go up, or at least stay flat, right?
Yeah.
It says that the risk is safer. I don't think I buy that. Do you buy that, Mike?
It's slightly safer than owning stock, but it's really not protecting a lot of your capital, is it, Kurt?
Right. It doesn't really provide much capital at all, beyond just a few percent that you pick up from selling the premium. If you make 2%, 3%, 6%, okay, great. If your stock goes down by 10, that's not a win. It's not a win, no matter what kind of math you want to use. Okay. All right. Is the reward limited? Yes, it is. There's only a certain amount that you can possibly make in this strategy. Okay. Now, I got a funny idea, Mike. I thought, why not flip that hockey stick upside down? And if I'm going to be bullish on stock, and if I own stock, why don't I, instead of mixing it with a short call, I'll mix it with a long put. And now I go along with this idea that it's safer. But this is very significant. What's going on over here, Mike?
Well, we've got a position that is safer. We've got a very limited risk on our position. It is bullish. It looks like we're expecting the stock to move up. And the reward is unlimited. So we've limited the risk, have an unlimited upside profit potential for bullish, of course, and we are definitely in a safer position, aren't we?
That's right. Mike, I've done plays, and you've done plays. I've done plays, for example, that started with 6% risk and ended up with a 42% return. Okay, so if I was wrong, the worst thing that could possibly happen is I lose 6%. But what did in fact happen is the stock returned me 42%. Okay,
right.
Being long on the stock. You had a slightly better experience last year. You were long stock, and also had a protective put in place. You had 7% at risk. Then you did some income methods like what we're going to show today that made that risk go completely away. So now you're bulletproof. You have infinite upside potential, but no risk anymore in the trade, correct?
That's right. I had bulletproofed the position. I had canceled that original 7% at risk. It was $1.50 or 7% of my investment. We had canceled that, and we still had unlimited upside.
All right, that's $1.50 a share on 300 shares.
Yes, that's right.
All right, and then what happened was you ended up with 59.8% gain. Pretty
That's
cool.
right. The stock exceeded my expectations.
Now here's where I say past performance does not guarantee future results, and here's also where I say, look, that isn't typical. I don't get 40% wins all the time. Mike doesn't get 60% wins all the time. But what we do all the time is we limit our risk down to single-digit percents, and that is the key to our success. That's the key. Okay? All right. I had gone broke mixing options and stock the wrong way. And by October 2002, I began to mix them the right way. Mike, I began to put some capital back into the market. I had lost everything, by trading on margin and doing covered calls and so forth, and it was ridiculous. But I bought Yahoo, bought eBay, bought Amazon at very reasonable prices, and those stocks went up in value. And I blogged about it, and soon people were asking if I had written a book about how to properly set up married puts. And I've been tweaking it ever since. Radioactive trading and the blueprint were born then. And I learned very early on that if you give things a great value away for free, amazing things begin to happen. I'm giving it away for free right now, Mike. We're going to give the setup of the Radioactive Profit Machine away for free. I do charge a little for an expanded version if you want to learn the 10 income methods. We're going to show one today. But if you want to learn 10 income methods, they're in my book, all right, which has had over $500,000 in sales, the book and the associated services. But again, it makes sense to show the value first. And look, if you want more, then you can, okay? All right, now, I'm going to ask a question of everybody here on the line, okay? And I'm just going to ask you to respond not using the polls, okay, just use the text. Would you rather lose 5% and then make 20% in your next play, and then lose 5% again, or would you rather leverage yourself with options and multiply everything times 8, lose 40%, for example, make 160%. Now, 100% is doubling your money. 160% is more than doubling your money. Okay?
Oh, yeah.
But then you would lose 40% again. Now, quick, don't get out your calculators, just quick. Off the top of your head, which would you rather do? This looks like a net 10% gain, I guess, and this looks like a net 80% gain. So, all right. Aman says, I've seen this in another video of yours. I'm going to go with the left side. William, is it William or Willis? Let me expand my thing here.
It's William, sir. It's William, Kurt.
William wants to go with the right side, okay? Who else wants to go with the right side? Steve doesn't. He wants to go with the left. Carl says left. Gina says right. Sharon says left. Ken says left. Okay, guys. Let's go ahead and do the math, all right? Let's go ahead and do the math. Thanks, guys, for writing in. We had a lot of folks on both sides of that equation, okay? Here's what it really does. A 5% loss, then a 20% gain, and then a 5% loss is a net gain of 8.3%. You can check me afterwards, but this is how the math works, all right? If you have $100 and you lose 5%, you got 95. You make a 20% gain on your $95, it's 19 more dollars, so now you got 114, right? But then you lose 5% from that. Hey, look, you're going to end up with a net gain of 8.3. Okay? Now, if you multiply everything by 8 and use leverage, a 40% loss, even with a 160% gain, if it's followed by another 40% loss, that yields a net loss. This is why it's very, very important to understand asset allocation. More important than understanding how to do a play, more important than understanding which stocks to pick, it's important to understand which stop to pick. Exactly how much loss you can tolerate. If you don't control your losses in the single digits, you're going to get in trouble. What if we were to increase the leverage even further? Instead of multiplying times 8, we multiply it times 10. Okay? So we have a 50% loss, then a 200% gain, which means tripling your money, and then another 50% loss. Well, that's a net 25% loss.
That's right.
Okay? Over 25% really, because we haven't even said anything about commissions yet. Okay? But look, just going from 8 times leverage to 10 times leverage, we went to 6.4 loss to 25% loss. And it's the same trading record. The more you increase your leverage at the wrong time, the worse off you are. So is leverage really the way to go? I'm going to say no. Here's the lie of leverage. Mike, like I mentioned before, I train folks in mixed martial arts. I weigh 160 pounds, and I am 5 foot 6 inches tall. and I'm 43. I'll be a grandfather in July. When a 20-something-year-old kid comes into my place and he weighs over 200 pounds and he's athletic, I don't fear him in the least. And the reason is because I understand some things about jiu-jitsu. I understand some things about leverage where I can toss him around like a kitten playing with a ball of yarn. True story. Come to my studio sometime. I'll show you exactly what I'm talking about.
No, thank you.
Yeah, well, maybe I'll show on somebody else, huh? All right, but here's the deal, okay? Once that 200-pound athletic 20-something kid knows the same principles that I do, now I'm afraid. Now I'm afraid. Now I want everybody to think of the market as somebody that's bigger than you, because it certainly is. And I don't know if it's necessarily smarter than you, but I will say that if you get into the leverage game, leverage can be used against you too. All right? And I've heard a lot of folks talk about this argument that married put is the same as a long call, but you need to look into the deeper math about it. Married put is not the same as a long call. It's the same as a long call plus the equal amount of capital. Okay? This might be over the heads of some folks in the audience, but the folks that are saying, hey, married put's the same as a long call, guess what? No, it's not. Married put is the same as a long call, plus you've got to have as much capital as you would normally use for the married put on deposit and doing nothing else with it but collect an interest.
That's right.
To really do this thing. Okay? All right. Now, Mike, let's, just before we do the RPM structure, we're going to do a very interesting exercise that shows what the deal is with this math, okay? And folks, you can go and you can do this on your own after we're finished here today, okay? And what I mean by what is the deal with the math, what I mean is, what does this have to do with you? This this thing that we talked about just now. Okay. Let's go ahead and find out. I've got a bubble here, Mike, that says I may be experiencing reduced audio quality. Can you?
It glitched there for a moment or two, and but I think it's okay now.
Okay, very good. All right, Mike, we're going to look at the trade simulator tool, and what this is. Whoops, I got to go back up. Gotta go back up just a smidgen. Okay, very good. All right, what we have here is a simulation of 100 different trades in a row. Okay, 2 losers, 2 winners, another loser. Oh, 3 losers, several wins in a row. Okay, here it is. At the end, there's a summary over here: 50 wins, 50 losses. Now, with a starting capital of $1,000, this these frames, okay, 10% on a losing trade. I'm sorry, on a winning trade, and 10% on a losing trade. If we have 50-50, all right, we take our $10,000 and we turn it into $6,000. Does that sound exciting to you?
No, and at one point we were even down a little bit more. At one point we were down 58% of what we started with a low value of about 4,200.
Yeah. And along the way, you know, some folks might mistakenly believe that they're in a winning trading system. It's like, hey, look, I'm up 61%. You know, but over the long haul, no, that's not how it works. Let me go ahead and run this again. What if we are right more often? Well, 51.49. Let's run this at a few until we have a really good record. This is random every time, ladies and gents, so please bear with me. Oh, there's a really terrible record. We're in trouble there. All right. Okay, hey, looky, now we got 53 winning trades and 47 losses. So, Mike, can you jot that down? 53 winners. Got 53 winners, that's good. And then at the end of all these 100 trades, we have $11,000. We started with $10,000, now we have $11,046. So we've made a more than 10% gain. Pretty cool. Along the way, however, we experienced a low value of 6,300, so maybe not so cool.
Yeah, 37% down. Most of us might have abandoned a technique at that point.
Right. Well, Mike, let's go up here, and we're going to mess with this. And I know what everybody thinks I'm going to do. What you probably think I'm going to do is I'm going to increase the target return. I'm going to not. I'm going to actually reduce the target return. I'm going to bring it down to like 8%. All right, but I'm going to also change something else. I'm going to change the loss limit to 4%.
Mm-hmm.
Okay, and that's not out of that's not out of this world, Mike. I've been demonstrating an average loss of about 4% or less in my losing trades for over 4 years now.
That's right.
All right, so so and then when we have the target return of 8%, let's see what happens if we run that simulation. Now, here's something interesting, Mike. I had more losers than winners,
Mm-hmm.
and still made money. Let's try it again.
All right.
Oh, well, with more winners than losers, of course, that's going to change. All right, look at this. Look at the string of losses at the beginning. This was random, but
Yeah,
look at all those losses at the beginning.
That took you down to your lowest value there after the 7th or 8th trade.
Right. Okay. So what we're doing here is, Mike, if this had been the same record over here, the same record of all those different losses, if we were losing 10% every time, what would we be down to by the time we get to the 7th trade?
And we'd be down to about 3,700, right? Another low value of about 63% down, 70% down.
Yeah, we wouldn't be doing so hot, okay? But because of tightly controlled losses on the downside, we didn't have to even have as big of a side. Isn't that something? Mike, I'm going to ask another poll here, okay? I'm going to say, looking back over your last 12 months, okay, are you happy with your trading results? We'll do that as a little baseline. And then after that, we're going to ask what we think the solution to the biggest problem is. All right. I think some folks are going to have great trading results, but I think some others are going to not, or at least going to want to improve what they do have. All right. Looking pretty good here, folks. Thanks for your participation. Doing these polls and so forth, they don't just help Mike and me to know who we're talking to and how we should pace the presentation, but also they're going to help you because some of these questions are Socratic questions, which means I'm asking them in the tradition of Socrates. I'm trying to teach a lesson by way of asking the question. And so it's really important to participate. Okay, Mike, I'm going to go ahead and close that poll here in another 11 seconds because we don't want to take up all of our time doing polls. All right. 3, 2, and 1. Oh, this is interesting. Everything's a multiple of 5. Oh, well, it was close to multiple of 5 there, and it changed. Okay, so 5% are super, super happy, made piles of money in 2010, doing great so far in 2011. That's awesome. Okay. 24% I'm happy, but I could stand to be happier. Okay, so that 29% of the audience is kind of a minority, wouldn't you say? Less than a third?
That's right. Less than, yeah.
Okay. All right. And then the rest, 51% said mixed emotions. I've won some and I've lost some. And 20% said I'm unhappy. They'd rather take a physical beating than a beating in the market.
True.
Okay. Well, did I not just show that if you limited your losses well, that you could avoid that beating? I think I did. You know, looking on here, even with 6 losses in a row, we still ended up with a pretty fabulous trading record just by limiting losses. Okay, now how can you actually do that? That's the question, isn't it? How can we actually do that? Okay, let's go ahead and get in here and we'll. Oops, where am I? Am I on the right page? Okay, be careful now. I might just reveal to you how you're going to beat the market in 2011. We just showed the Trade Simulator tool on the Resources tab at Radioactive Trading, so if you want to go there afterwards, follow the directions, use what kinds of parameters you're already using for your wins and your losses, okay, and plug that in, and see how that might look after the long haul. Okay, and then try and take a look at how it might look after a radioactive trading type of setup. Okay, now here's the structure of an RPM, a radioactive profit machine. What you do, Mike, is you pick up shares of stock, and you had said to me, "I don't like this," and why didn't you like it?
Well, I knew the common structure of a married put and standard collars, for example, in a standard protected put, married put position. We're always taught you buy shares of stock, you buy a 1 month out put, that's below the current stock price. You're only paying 80 cents or $1 for the put. You have 30 days of protection. You know, you're only risking maybe 8, 9, 12% on the position, and you're hoping the stock moves up. So when I first saw this, I said, okay, you're buying stock at 27.35. You're buying a 29 put. I get it, but you're paying $3.50 for it. So now you've got $30.85 invested in the position because this particular put option was several months out in time. And I said, well, Kurt, you're not going to make a dime unless the stock's trading above $30.95. I just think that's, if you have that big of an expectation of a movement in the stock, maybe just buy the stock outright or buy some calls, I think is what I said to you.
That's right. Now, I want everybody to maybe write this down, or at least remember this. Mike said you're not going to make a dime until your stock goes to $30.95 because the cost here is $30.85. Okay. Now, I'm going to go ahead and Mike, I hope you don't mind if I prove you wrong.
I've done it before. You'll do it again.
But the fact is that as that stock goes up, the put does not come down dollar for dollar. All right. And another thing too is I'm able to do some nice little manipulations in here and take that down. Okay. So check this out here, Mike. I at least have this going for me. I have a $29 guarantee to exit, and here's why. I own the put option. If the stock does fall below $29, so what? I get to sell it for $29. And so my only risk is the difference between the $30.85 and the $1.85 that is left. Okay, I'm sorry, the $30.85 and the $29 that I can guarantee back. So it's a $1.85 risk, and $1.85 divided by the $30.85 equals 6%. Okay, so that's the beginning point. All right, the beginning point with the married put. Now, if the stock decides to go up, I can make money. If it goes down, I can't lose too much. All right. Now, this break-even line, remember, $30.85 is exactly what I paid for the stock in the put. Right?
Yes, that's right.
All right. So that break-even line intersects here at $30.85 for the stock. Yes.
Mm-hmm.
Yes, that's what they all say. Right? but here's the deal, Mike. 3 different things have to happen for that to really be the break even. Okay. The stock, you know, it has to be at $30.85, which I have no control over, and I have to hold it all the way till expiration, which I do have control over. I don't have to hold it all the way, do I? And,
no.
And I have to make no adjustments. No adjustments, like the money net trade that I showed at the beginning. I know a bunch of folks have joined us since, so you probably missed out on that first part. But I'm going to show the money net again. Don't worry. Okay, I'm also going to show the management of it. And here's the deal, Mike. I am not going to have to wait until the stock is at $30.95 before I'm making money. In fact, I'm going to guarantee to make money way before then. Okay, there's that maximum loss of 6%, and I'm not going to lose it. Now, Mike, real quick, we're going to compare owning 3 positions. Okay, and this is because of earlier in the presentation I had said cut your losers short, let your winners run. Right?
Right. That's our goal.
All right. We're going to compare these 3, and then I'm going to show the money net and its management. I think folks are going to just really be jazzed, especially our spread traders. Okay, but just as the setup, okay, Mike, if I'm buying straight stock, or if I'm mixing a short call with my stock, or I'm mixing a long put with my stock, how do things get skewed from the beginning? Well, if I've got just stock and the stock goes up 20%, well, how much have I made?
You made 20%. Let's not include commissions. Keep it simple.
Okay, very good. All right. So the covered call, I'm going to still make money, but not as much. How come?
Well, you capped your gain. We capped our upside by entering into an obligation to deliver our shares of stock at a set price. We did receive premium to sell that right. So the stock moves up, we get assigned at our short call strike price, we make 5%. Not a bad return for a 30-day period.
That's right. Now, the married put is going to make less, too. And the reason it's going to make less is that the stock, as the stock goes up, the put is going to come down a little bit as well. Okay? And I say a little bit because it's a put that we buy that's far out in time. If it were a put that was out of the money and instead of in the money, if it was out of the money and it was just a few weeks away or a month away, yeah, it'd come down very quickly. But that's not how it works when you buy a put that's way out, like 6 or 7 months or better. Okay, so the Mary put is going to yield less, all right, but it's going to yield less than the stock. Okay, now let's put our profits into a new play because all 3 positions made money. All 3 positions were bullish, right? Because owning stock was the major part of all 3 plays. Now, let's say our stock goes down 20%. What happens to the guys that own stock?
Well, we're going to lose 20% this time.
Yeah, that one's easy. What about the guys that are playing the covered call? They're not going to lose as much, are they?
No, they took in a little bit of premium again, so, you know, it drops down, they lose 15%. They still keep the 5%.
Right. Now, Mike, you saw me just now with the Altera radioactive profit machine. You showed me, I showed 6% maximum risk, right?
That's right, but that was for
Right.
a 6-month period, essentially.
Right. What if the stock goes down 20% and I've still got 5 months to go and I say, that's it, I'm out of here. And am I going to lose that whole 6%, or is it going to be something in between?
No, you're still going to have some time value on it, so you won't lose the full 6%. You might lose 5, you might lose 4.5 in that range.
Right. Okay. So, and that's without any adjustments. Okay. So here's the deal. Here's the net. All right. When the straight stock makes 20% and then loses 20%, where are we at?
Well, you'd want to say we're at even, that it was a wash, but it's not, is it?
No, that's the phenomenon that we talked about before, okay, where the percents, you know, the more you leverage something, the worse it goes against you, okay. Here, with the stock, we didn't have any leverage. There's no leverage at all. But making 20% and then losing 20% didn't put us in the same spot. Here's why, okay. Let's say you have $100. You make a 20% gain. Well, that's $20, right?
Sure.
Yeah. Yeah. So now you have $120. Now you take that $120 and you lose 20% of it. Well, losing 20% of $120 is $24. So you lose that $24. Wow, you're actually behind the curve here. Okay, and it works the other direction too. If you made 20% first and then lost 20, you know, it'd be the same deal. Okay, same net result. What about the covered call? Do you suppose that'll be better or worse?
Yeah, it's going to end up being worse, isn't it? Because we were capped our gains on the upside, and then we still suffered a reasonable loss.
Yeah. Okay, so we're going to end up getting hurt just a little bit worse on the covered call, and that's because it has sorted the winners out of our account and left us with the losers. Okay. Now that's something that our covered callers can really relate to, I think. Okay, the Mary put makes 15%, then loses 5%. Okay. How about them apples? This is the only one that had a net gain out of the 3 positions. It's the only one that we began with this skew and got a net gain. Same market, right? Different end results.
Okay, can I address something real quick, Kurt?
Do that.
Okay.
Do you have a question coming in?
Yeah, Walter had a couple questions, and they were good questions, but he said, well, what about just doing a dynamic collar? Well, there's a particular... Well, it is, but you know, if we did a married put, if you did a standard collar, by the way, which I trade in my account sometimes, I'll buy a stock, sell an at or just out of the money call 1 month out, and buy an out of the money put 1 month out. It has the risk reward much like a credit spread, limited gain, limited risk. Now, in this scenario, if I did that collar first and the stock went up, because I paid for the put, I might make 3% instead of 5% with a covered call, and then the next time the stock drops 20%, I'd only lose 5%. The collars, the standard collars are arranged so it's not the true profit to loss. In other words, you will never have a one-to-one profit and loss. There are specific blogs, Walter, and other discussion on radioactivetrading.com as to why we don't sell a call right away when you open this position. If you sell that call right away and the stock, you know, moves up in order to get a good premium, you're going to sell a call below the put strike price, you'll actually increase your risk on the upside in the direction you thought the stock was going to go. And then, of course, you mentioned about, well, if there's a sudden implied volatility drop in the stock, in the put option, that could hurt your profit potential. Well, true, but that's discussed in the blueprint, and there is a filter on power options that I've been using for a while and discussing with our blueprint customers and our fishing customers, which can prevent you from doing that. Now, very quickly, Kurt, Amon also wrote in after that, but if the stock went down 20% on your married put, wouldn't you exercise the put? You cannot cash in the time value? No, if we still have 6 months or 5 months left on the put, if we guessed wrong in the first month and the stock collapsed, we'll sell to close the stock and then sell to close the put.
Yeah.
But we'll still take advantage of that time. Yeah, you'll get more for that, and we take advantage of that. You don't exercise your put right away. If you still have 4 months or 5 months or 3 months of premium on it or time value, Amon, we would just sell to close the put.
That's right. That was shown recently when in TAP, I was in Network Appliance, and Network Appliance went down 10.8%, and I liquidated, and I got out at a 1.2% loss. 1.2% loss. Okay, so I still had 98.8 of my marbles left to go into the next play. Okay, Mike, does this saying work now? The cut your losers short, let your winners run. Does that work when we set ourselves up with the married put?
We're forced in that position, aren't we? We're forced to be in that setup where that is doing it for us. We're not doing it. We're not managing. We're not watching the market every day. It's doing it for us.
Okay. Using that idea, okay, using the 6% that I showed in the Altera trade, if you kept your wins last year, this is for everybody in the line, if you kept your wins from last year, but your losses were limited to only 6% of the capital that you had in any one trade, or, you know, for example, I was in more than one trade at a time. Let's say that the dollar amount risked is only 1% of the capital total that you have to trade with. All right. Well, would that have made a difference in your trading last year? We had, I think 5% say, yes, I'm very happy. Loads of money in 2010, doing good so far in 2011. We had 5% say that before. I expect we're going to have some more folks in that category now. Okay. Let's go ahead and leave that pull up for another 5 seconds. 3, 2, and 1. Let me close it, share the results. Mike, we've got 31% in the yes, I'm very happy category. We had 38% say, I said no or mixed emotions, but I would have been happy.
Okay.
Right? 17% said I had a losing year. This would have made the difference in a winning and losing year. Okay. And 14% would have still lost, but lost much less. So, Mike, did this benefit? And nobody said, well, geez, you know, Kurt, I already practice this kind of risk management, and I don't see how it would help. Would I be way out on a limb by saying that 100% of everybody on the line that answered this poll would be benefited by radioactive trading? Would I be out of line to say that?
No, that is completely accurate, Kurt, because you could even say, okay, well, 86 would have moved to a winning year or been happier, and only 14%, you know, would have lost less. But that's still 100% that would have done better, performed better over the last 12 months.
That's right. I'm going to ask folks to just put a dollar amount on that. Just put a dollar amount on that. And if you don't think it could help you at all, if you don't think that forcing yourself not to lose too much when you're wrong, but leaving your upside open, if you don't think that'd be a benefit to you, go ahead and say so. That's fine. Not a lot of folks do, but you should if you really believe that way. And some folks may have saved at least $350, some $1,000 to $5,000, some $5,000 to $10,000, some. This information would have made $10,000 worth of difference. So let's go ahead and Mike, we do have some takers on all 5 categories. All 5 categories. Leave it up for another few seconds, and then, Mike, we're going to show the riskless spread trades that I promised.
That's right. And we're going to go a little bit over, folks, so we apologize for that, but typically we usually go to about 1:15 or so on these presentations. So.
Yeah, we go to about 1:15. Look, guys, if you have to check out because of work obligations or other things, go right ahead. There is a recording going to be made available of this, and you're not going to want to miss it. If you're a spread trader, you're gonna think this is ridiculously cool. Okay. All right. Let me go ahead and I already did share the results. So 3% didn't get it. I said, well, I don't see how forcing yourself not to lose too much could even help. Okay.
Right.
Well, I'm going to say, look, guys, paper trade it. paper trade it and see if or you could even back test it. You could look at your losing positions from last year and your winning positions from last year. Go back in and using the power options tools. I'll send you a link. Okay. Let me send the link to everyone here. This is kind of cool. www.poweropt.com/RAT for radioactive trading. If you go on there, you can get yourself a couple of free weeks. No obligation. There's no credit card or anything. But you can go on there and back test and see exactly what this would have done for you. Okay? Looking at the setup of a married put. Okay? Instead of just straight stock or just doing straight up spread trades. Okay, all right. 6% would have saved at least $350. 57% between $1,000 and $5,000. 23% $5,000 and $10,000. We had 11%. That's 1 out of 9 on the line. This information that I've shared so far would have made a $10,000 difference in your account, and I haven't even shown you the spread trades yet.
Okay.
Wow.
Let's address this quick point that Dom wrote in. I believe Dom joined us on maybe it was Tuesday or he joined us last week. I can't remember, but he mentioned this towards the end of the presentation. We didn't get a chance to do it, and he brought it back in. He says, "You folks are assuming the probabilities are symmetric. With the married put, if the stock is unchanged, you lose money. Yeah, we're going to lose some time value on the put option, and the stock's unchanging. If we were long stock and the stock wasn't moving, we didn't make anything. We didn't lose anything. We didn't make anything. And on the covered call, you're making things. But how often do stocks stay unchanged? How often do they stay right in the 50-cent trading range? No, you're right, Dom. You're absolutely right. We're assuming the probabilities are symmetric. And if the stock is unchanged, you're going to lose time value, and you're going to lose time value, and you're going to lose time value as you're holding the put. You're absolutely right. That will happen. But remember the 3 things we saw in the profit and loss chart. We're only going to realize that whole maximum risk, this 6%, if we hold the position all the way to expiration, which is at least 6-7 months out in time. If the stock's still trading below our put strike price, okay, it's unchanged, so Altera would still be at $27.35, and we make no adjustments. The 10 different income methods that are discussed in the blueprint, about 5 of them can be used if the market's moving up. They're best used if the market's moving up, I should say. They can also be used if the market's moving down. 2 of them are really designed to work if the market is stagnating. And there's a couple that work if the market is moving down, if the stock's moving down after we enter in the position, to make sure that we're gaining back what we're losing in the time value or repositioning our position on that situation. So, Dom, that's right. Now, we just ran that scenario of, that going there. But, again, how often does stocks stay the same price for months and months? And, by the way, if you're a covered calls trader, Dom, and you say, well, I like to trade stocks that say neutral and I trade covered calls and just get premium month by month, well, if you're trading a stock, if you're trading a stock that's 5 or 6 months period doesn't move, eventually there's going to be no volatility on that stock. There's going to be no implied volatility in the option. So yeah, you're generating maybe 20 or 30 cents for the at-the-money call month by month, similar to what you might see on Kraft or Annaly Mortgage, which pays a 19% dividend. And I have a lot of investors that do that, and I did that for a while too. But if the stock is unchanged and you're just doing covered calls, you're not getting that 5% premium now.
No, that's not going to fly. Well, Don, I can't think of any bullish position that you could possibly take that doesn't lose you a little bit of money if it stays flat. But let's go ahead and look at how this works here. Okay, Altera at $27.35, the March $29 put, total invested $30.85, guaranteed exit $29. And my at-risk amount is $1.85. Now, Mike, my mission is to eliminate that risk. I want to take it out. Okay? So, the adjustments, these are the riskless spread trades that I was telling you about. I call them income methods because they're almost always done at a credit. And remember, Mike, when everybody saw the RPM setup, what you said was, hey, wait a minute, Frankenberg, you're spending $350 for a put option that raises your cost basis of the stock only of $27.35 to $30.85 a share. So you can't make any money until that stock goes to $30.86, right?
Right.
You don't make a dime until the stock goes to $30.95. That's what most folks believe. Okay. Well, Mike, let's take a look at how that really works in the radioactive trading scenario. On September 24th, 10 days after putting together the RPM, the radioactive profit machine with Altera, I would buy one call and sell two at a higher strike. Okay, and here's what happened. I sold two October 29s at 85 cents for every one October $28 call that I picked up at $1.45. Okay.
Okay, so it's that
Now,
money net trade again. We're selling two, but we're buying one, so we're not naked.
right. So I have a net credit. I have made 25 cents for putting this together.
Mm-hmm.
Okay. Pretty cool. Okay. Now, here's what happens. Okay. The total invested amount for my RPM, for my radioactive profit machine, the stock plus the in-the-money put option, that's far out in time.
Mm-hmm.
The total invested amount was $30.85, and now I have brought it down by 25 cents. So now the new cost basis is $30.60, and I still have the $29 guaranteed exit, so I have reduced my at-risk amount from $1.85 to $1.60. Pretty cool so far?
Okay, well, we've done the thing. You opened the married put. You had some risk. You're doing a technique that's lowering the risk. Okay.
Right. Now, Mike, at expiration, this is on expiration Friday, October 15th, Altera, it ended higher than this, okay? But on the 15th, during the day, okay, Altera was trading at around $29.40. Okay?
Mm-hmm.
And so those short calls, what was going to happen to me with that stock? You know, I had sold $29 calls. What's going to happen?
You're going to get assigned. You've got that spread there, but you've got two short calls that are in the money, so you're either going to have to manage it or just let the position get called away from you.
Yeah, but I like Altera, so I want to keep it. All right. So here's what I did. Okay. Now listen, I had received 25 cents for doing income method number 5, the money net. Okay, I had received 25 cents,
Mm-hmm.
and I needed to pay 55 cents for each $29 short call that I closed. Okay. All right. Now, Mike, if I close one of the shorts, remember I've got one long call and two short calls. If I pay 55 cents to close one of those short calls, doesn't that put me behind by 30 cents?
Yeah, you're adding risk back into the position, essentially.
Okay. Well, let's not forget something, though. Back on September 24th, I had bought $128 for each two $29 calls that I had sold, right?
Yes.
I did collect a 25-cent credit. Okay. One of the short $29 calls is against stock, and one of the short $29 calls was written against the $28 long call, right?
Mm-hmm.
I think all of my spread traders are still with me, and folks, if you're not still with me, that's why I wrote a whole book about it, okay? But dig this, okay? On October 15th, I buy back just one of those calls for 55 cents.
So the stock is now uncovered. It's now free, for lack of a better term. It's not capped.
Yeah, the stock is not going to get called away from me because I don't have any short calls against the stock. I've got short calls against long calls.
A debit spread,
Make sense?
essentially.
Yeah, I've got a spread. Okay, now let's just take a look here. It was a 25-cent credit for putting the spread together in the first place, and to close one short call, it cost me 55 cents. So it looks like I've spent 30 cents. But what I've done is I've spent 30 cents in order to keep my stock and also have in place a long $28 call and a short $29 call. That's a bull call spread, isn't it?
Yes, you're going to be assigned, you're going to be forced to deliver shares at 29, but you have the right to buy them at 28. So you're going to get a $1 difference between the strike prices.
Hey, and I've spent 30 cents for that dollar, okay? Here's another way to look at it. I bought one and sold two calls against the stock. It's like using a covered call, selling a covered call against the stock to finance the purchase of a bull call spread.
Mm-hmm.
And guess what? That bull call spread is definitely closing in the money.
Right.
Closing one of the shorts leaves the bull call spread in place. I have one long 28 call and one short 29 call. My debit so far is 30 cents, and Altera is trading above $29. What's going to happen in the middle of the night? Well, my broker is going to look and say, hey, Frankenberg's got a $28 long call, and it's in the money. We're going to exercise his right. We're going to give him 100 shares.
Mm-hmm.
And then the same broker is going to say, wait a minute, Frankenberg's also got a short call. We're going to sell at 29. So in the middle of the night, I buy stock for $28. I sell it for $29. I make that buck, and I've paid 30 cents for the privilege to make $1.
Mm-hmm.
Pretty cool. Where I come from, that's the 70-cent credit for me to keep a stock that I sold calls against. Try that with a covered call. That's kind of cool. Okay.
Now, do you have the comparison next of if you just did the covered call? Okay, I wanted to make sure that was there. Let's go.
Yeah.
Sorry about that.
Yeah. What if I had just done a plain vanilla covered call trade? Because a covered call trade does generate income too, okay?
Mm-hmm.
Now, if I had done a plain vanilla covered call and just sold the $29 calls, all right, I would have made 85 cents, and then when I buy to close them so that I can keep the stock, I would have to pay 55 cents, just like I did, all right? And now my net premium would be 30 cents. Well, wait a minute. I had a net premium of 70 cents instead of 30 cents. Which is 133% higher. Mike, do I still own the stock?
Yes, you do.
I still own the stock. And I got paid 70 cents for sitting on it and waiting. And did I introduce any risk at all by doing that?
No, you reduced the risk because of the credit you received. And, I'm sorry, you reduced the risk and then you captured the extra premium. And it's always important to show that comparison, because you look at it and say, oh, Kurt made 70 cents. You could have made 85 cents if you just sold the covered call, but not if you include the buyback to keep holding the stock. Now, Kurt, a couple questions coming in. One main question: what if the stock went to 100?
Well, if the stock goes to 100, I'm going to probably be forced to sell at 29 because I don't want to. Let me start over. I'm going to have to sell it at $29 because I don't want to buy to close that $29 call for 71 bucks. All right.
Right.
That's not going to work out. Okay. But my put is far out in time, so it may still be worth something. And I'm going to be delivering those shares at 29, but I'm going to also collect the $1, and I've already collected 25 cents. So it's going to be as though I'm selling for 30.25.
Mm-hmm. And that's what I wanted you to point out there is you were getting to it, but this is what's discussed in the blueprint. When Kurt put on the position, he didn't just put on the position and say, I'm expecting the stock to stay right at this price. He looked at it with all scenarios. If the stock falls, I was okay lowering my risk by this much if all calls expired worthless. If it shot up to 100, I'm okay with the fact that I might be assigned the what-if scenarios for each income method that are applied. So he knew ahead of time that if it went up to 100, he was still okay with that scenario. Yes, income method number 5, done in the 2-to-1 ratio that was discussed here, will cap the gains with that extra short call. But there are ways to do it where it won't cap the gain. And income method number 6, another one of the money nets, also will leave the upside open even though you're generating a premium.
Right. We don't have time and the ability to share income method number 6 right now, but if you did have that expectation but you wanted to collect a credit in the near term, you could leave your upside completely open.
Mm-hmm.
Okay? Now, Mike, here's what happens. Remember when folks had said before, and you said before, geez, Kurt, you're paying a lot for that put option, and it raises your cost base from $27.35 to $30.85 a share. You can't make any money until the stock goes to $30.86.
Mm-hmm.
Remember that?
I remember that.
Well, usually early in the presentation I say, hey guys, what do you normally do when you hear an idea that contradicts what you've learned before? Okay, and most folks say, well, I have an open mind. I like to listen to it.
Yeah, I made my comments at Kurt and said, I'm concerned. I say that to all my customers. I'm doing this ratio back box spread. I say, okay, I'm concerned. Let me tell you why. But this is what I told to Kurt. But he said, come to my webinar and I'll join you. And I said, absolutely. I want to see what you're doing. I want to get to know this a little better because I like the limited risk. But let me show you. Let me see how you're doing this.
Very good. So, Mike, here's what I'm going to show next, okay? Income method number 3, and this is the last thing we're going to show today, okay? But I thought I'd just fulfill the promise, and here's a little bonus, all right? Income method number 3 is another riskless spread trade. You see, what I did, Mike, remember the stock was trading at 29.40 when I did this. It closed a little higher that day, but it was trading at 29.40, and the put option had come down from 350 to 252. Now the stock had advanced by a little more than $2, but the put option came down by only 98 cents.
Mm-hmm.
And remember, I just collected 70 cents to offset even that. Okay?
That's right.
All right, so I sold to close the March 2011 $29 put option, and in its place bought to open a November 2010 $30 put option for 162. Because the stock is advanced and because this is a near expiration, this put is lower priced than that put. Now, is this a credit or a debit?
Well, this is a credit. We're getting $2.52 for selling the close the put that we own, and we're only paying $1.62 back. So you're receiving 90 cents now again against the cost basis of your radioactive profit machine.
Wait, do you mean to tell me I've gotten paid another 90 cents?
That's right. You're taking another 90 cents into your account against the position.
Okay, and what I've done to do that is I've actually swapped a $29 put for a $30 put. Yes, I decreased the time frame, but guess what? I was okay decreasing the time frame.
Mm-hmm.
That's what I wanted to do. And look at what happens, okay? Our cost basis after doing income method number 5 was down to 30.15, okay? And the credit from the income method 3 trade makes my new cost basis for both stock and put down to $29.25. But it's a $30 put that I've swapped for.
That's right.
So my $30 put guarantees that I can sell for $30 if I want. Do I have any short calls limiting my upside?
Not right now, no. You've already adjusted income method number 5. All you've done now is swap the put, and you don't have anything limiting the upside profit potential.
What's my maximum risk?
It's negative. You are guaranteed to get a higher payout than your cost basis. So worst case scenario, if Altera went down to $1 per share tomorrow or 1 cent per share, you're still guaranteed to make a 75-cent profit, and you also have unlimited upside profit potential.
Right. Now, I'll tell you why I did this on October 15th. I did this on October 15th because earnings were due out on November 4.
Okay.
And November expiration happens after November 4.
Mm-hmm.
But I wanted to go into the earnings announcement being bulletproof, having no risk whatsoever. In fact, having a guaranteed gain. So I've got this guaranteed gain figured out, right, of exactly 75 cents per share. All right. Going into that earnings announcement, I have reduced my break-even gap to less than 0. To where now I can't possibly lose. Now, if the earnings announcement goes my way, great, and if it doesn't, well, that's fine. But I want to address this question again. Remember that the net cost basis for Altera was $30.85, $27.35 for the stock, $3.50 for the put, and folks had said, well, you can't make any money until the stock goes above $30.85. Well, what is that? Due to the, I mean, what does this that I've just demonstrated do to that argument? When the stock is only at $29.40, I not only have locked in a 75-cent profit to where I can't possibly lose, I've also still got unlimited upside.
That's right.
Okay. Now, after the earnings announcement, Altera had a bump up, and I ended up selling for $33.10, which was a $3.85 per share profit rather than 75 cents. But worst case scenario, I've got this profit. Best case scenario, I got that profit. Kind of cool. Okay, so using that initial investment of $30.85, I got myself bulletproof by using a ratio call spread in the context of the put, and then after that, a put adjustment. Okay, when the stock was only at $29.40. It ended up being a 12% profit in 6 weeks. Never had more than 6% at risk, and I was bulletproof before the earnings announcement. And that's how we roll here. Okay. Now, Mike, I showed everything with 100 shares, but the fact is that I did do this with 500 shares, which means buying 5 put options and buying 5 calls and selling 10 calls against and so forth. And to be truthful, I do need to include the commissions. Okay, so commissions did cut into it. It wasn't a 12% profit. It was 11.9. Okay. But again, it's a very, very brief investment of about $15,000. Best part of the story is neither of these nested spreads introduced any risk, even though both produced a credit. You know, who was it that posed the question, what if Altera went to 100, which is unlikely, but who had posed that question?
Oh, I can't remember now. I'm sorry. I apologize. I had 6 or 7 questions come in. It wasn't Walter's question. It was Ben? Oh, wait, hold on. Anyway.
It's immaterial. I'll go ahead and answer the question. I was happy risking $1.85 a share. And by doing the ratio call spread, if the stock had gone to 100, I would have gotten out, and I would have a small loss, okay, of about 60 cents. All right, so if I had been okay with $1.85 and doing the ratio call spread, reduce that to 60 in a very unlikely event of the stock going to 100, I'm still okay with that. All right, but the fact was it did go above $29. It did need management, but the management actually paid me to hold on to the stock. Kind of cool. And that's what I expect to happen tomorrow. I'm tracking right now 7 or more. I think it's 7 money net trades that are going to expire tomorrow. So going to be cool. I'm especially looking forward to Lulu, what Lululemon Athletics is going to do. Okay, so Mike, I know that we've probably got some questions. I'm going to skip over these little illustrations that I've got here that are for anticipated questions, and I'm going to get to the offer. Okay, because let me run a poll here real quick. What 2 things do you like about radioactive trading? Do you like the idea of starting with very low risk in the beginning? Do you like the opportunity to adjust your risk and take income while doing it? Do you like the possibility of being bulletproof? Or taking income by way of spread trades that don't introduce risk? Do you like the idea that there are 10 total income methods? I shared 2 today, but 10 total income methods, 10 different ways to skin a cat that work in different markets.
And we haven't gotten to the offer yet, but what is contained in the blueprint is, we had a question come in. Well, income method number 3 that you showed is similar to income method number 4. We'd use that if the stock moves up, but how do you choose one over the other? Well, that's what's described in the blueprint. It discusses the SIGA model for each one, and there's a specific time when you do 3. You're okay shortening the time because you're comfortable with the return, getting out of the trade. You're expecting maybe an earnings pop or an earnings event. And income method number 4, I might be expecting further growth.
Okay. Mike, I'll go ahead and flash up the offer because we've got just a brief period. Or actually, no, we were over by about 4 minutes, and I want to respect everybody's time. So let me go ahead and close this poll. How do I find these kinds of trades? This answer, the top answer, I've already sent you a link, and that was www.poweropt.com/RAT. You can, without a credit card, with nothing but your name and your email address, you can get yourself a free 2-week trial. And the married put position platform will show you how to find these kinds of trades. Use the radioactive settings, and definitely get a conference call going on with Mike. Okay. Sorry, Mike, I'm making you more busy.
No, that's okay. That's quite all right. I love it.
Good. Second place was let's hear the offer for the blueprint. So I'm going to go ahead and do that right now. Okay. Here's what you get with the blueprint: 250 pages of instruction on limited risk, high potential return trading, and all 10 income method adjustments. Now, first of all, don't be intimidated by the 250 pages. You're going to learn most of what you need in the first 3 chapters. And then after that, The income methods are for different markets, and they're also for different temperaments, trading styles, goals, long-term goals and short-term goals. You're going to have plenty of examples and plenty of support as far as how to master your favorite income methods, okay? But it's all there for reference. All 10 income methods are there for reference, okay? So that 250, you don't have to read 250 pages before you know how to trade radioactively. You only need a few chapters, okay? The quick action guide is a white paper, or I'm sorry, a PDF that will teach you how to convert your positions from stock positions to radioactive, and how to begin practicing the risk management strategies that we use. Foundations of Radioactive Trading CD talks about how to manage multiple positions. If you have several and you want to know how to ideally and properly allocate your assets so that nothing's you're not too heavy in one stock and too light in another, okay? And then a free month of power options will be included if you pick up the blueprint. Okay, here's what it costs. It's $339. That's about a tenth of after considering shipping. It's about a tenth of what it costs to go to some of these weekend seminars. And Mike, I've been told that it's more educational. Okay, so what if that investment were a married put? Okay, and it's $339. If you if the investment is worth it, it's going to make you more than the $339, right?
And
if it's not worth it, it's going to lose you $339.
That's right.
Okay. Okay. But what if we were to put in a guarantee? That would make our investment well, bulletproof. Okay. We're going to take out all the risks. So that's what we're willing to do. If you pick up the blueprint today, go ahead right now. www.radioactivetrade.com on the products tab. You'll see all the benefits, all the bonuses, and the fact that we do guarantee it 100%. If you're not happy, just send her back. Okay. I'm going to dismiss everyone that wants to leave, but Mike, is there a couple of questions that have come in that, you know, if folks want to stay on the line, we could handle for them?
Well, we talked about the 3 and 4. I'm sorry, when to use 3 and 4. There were some discussions that I think we discussed, we touched upon about, doesn't this income method number 5 cap your gain? Yes, if done in the true 2-to-1 form. If I have 100 shares of stock and I sell 2 calls and buy 1, my gain is capped. I can manage it, but the profit and loss chart, my gain is capped. Now, everything in radioactive trading is scalable. Kurt was doing 500 shares of Altera. Well, let's say he was doing 400 shares. Could he have done the same 2-to-1 ratio by selling 4 calls and buying 2 calls? Yes. And now that leaves 200 shares of stock completely uncovered, so he still has an unlimited upside, but still takes advantage of the income method number 5 adjustment. So there are ways to do that.
Mike, there's a way to, that we don't have the time to share right now, but there's a way to do income method number 5 and still leave the upside open.
Yeah, that's what I was just referring to.
Oh, I see, I see.
You have 400 shares, you sold 4 calls, and you bought 2. So technically, 2 of the shares, 2 of your short calls are covered by the 2 long calls. The other 2 short calls are covered by 200 shares of your 400 shares, and then you still have 200 shares open, which are not obligated by any short calls.
Got it. Mike, I'm going to leave this screen up. I'm going to flash this up once when I said if you kept your wins from last year, but you limited your losses down to 6% or less, what kind of difference would that have made? And 100% said that it would have improved their trading. And when we asked what the dollar amount would have been, well, a better question than what do you think it would have been last year is how much better do you think your trading might be this year?
Right.
97% say they would have more than paid for the blueprint, and 3% didn't understand how forced loss limits could keep you out of trouble.
Yeah. In case anyone else was curious about this, just want to spend a minute or two going over Dom's last question. He wanted to know what does the Power Options service provide? Well, Kurt's website, radioactivetrading.com, this is where you can buy the blueprint, the products related to this trading technique, and of course a lot of Kurt's blogs and his articles, free information on the radioactive trading principles, what we've been discussing today, the setup of the trade, the income methods, and so forth. Now, Power Options is a patented suite of search and analysis tools for self-directed options investors. You can, in the Married Put search, you can put in specifically, there's about 15 to 20 different actually 20 to 25 different option criteria, about 35 different stock criteria. So you can put in specifically what kind of stocks you want to see, what kind of risk you want, time frame on the put, and Kurt's basic techniques, basic criteria that he discusses in the blueprint are already there for you to use as a stepping stone. So you're identifying only those positions that match what you want to see. We do support over 23 different strategies. And then you can quickly research and analyze those positions, run your what-if scenarios. We talked about that. And we also have a very powerful set of portfolio tools, whereas you're tracking positions, whether they be married puts or even standard collars or spreads, you can link to an analysis screen. We'll see side-by-side comparisons of the potential income methods that you might want to look to trade following the rules in the blueprint, or adjustments to those positions as well. George wrote
Mike,
in.
let
go
me
ahead.
address George. George had written in, can you use this system to go short? In other words, to short the stock and buy calls. Okay.
Married call.
A married call. And there is a search like that on Power Options. But the method that's discussed in the blueprint is actually different. And I like that you're using your imagination there, George, and it does make sense if you short the market to protect yourself against upswings. Okay. But the method that's discussed in the blueprint is not what you're thinking. It's not shorting stock and buying calls. It's something completely different. But I will say that yes, the radioactive principles work by going down. Glenn wants to know buying an EFT. Yes, you can buy an EFT, and you can trade EFTs with this. I've only ever lost once, and it was a very small amount that I lost playing EFTs. Every other time I've won playing EFTs.
And also, I think what he was asking is, you can also what's discussed in the blueprint is using the inverse ETFs as well.
Oh, for if you're bearish on stock, if you want to use a reverse ETF, one of the bear ETFs,
that's a possibility. Yeah. And
the
reason why, it's discussed in the blueprint. And there is a reason why we don't advocate.
Oh, Glenn was making a guess.
Oh,
I get it.
Okay.
Glenn was making a guess. Nope. It's not the method that's discussed in the blueprint. The method that's discussed in the blueprint for going short is not shorting a call and shorting the stock and buying a married call. And it's also not the short ETF, although that is a valid technique.
Yeah, that's one that Ernie and I actually advocate.
Yeah.
As well as what Kurt wrote in the blueprint, of course. But yeah, we also advocate the other one, using the inverse ETFs, because then you don't have to change your way of thinking. The income methods are still the same income methods, and stock is moving up. Your inverse ETF's moving up as the stocks goes down. So, all right. And Dom had a question regarding something, because I talked to Dom when I was out in Texas, so I handled that one, Kurt. I think we're good.
Very good. Okay, gang, thanks for sticking around. The folks that stuck around for the extra questions. If you think of a question, as you often do, after we quote-unquote hang up, go ahead and just send your question in written form to support@radioactivetrading.com, and Mike or I will be happy to get back to you. Too sweet. Mike, thanks for coming, and folks, we'll see you out there. Tomorrow's Expiration Friday, which I call payday, particularly because I have a number of money net trades in place. So, okay, we'll see you out there, gang. Happy trading, and bye for now.
All right, take care, everyone. Happy expiration.